Welcome to CrushTheStreet.com's weekly market wrap-up. Let's get started in the equity sector, which saw red amidst speculation of job growth concerns and rising food prices potentially hindering a tepid consumer confidence trend. The benchmark S&P 500 closed at 1,888 points, down 0.1%, while the Dow Jones ended at parity against the prior session. The biggest loser by far was the Nasdaq Composite Index, dropping nearly a full percent and giving up most of its gains from earlier in the week. Before the opening bell rang on Monday morning, Wall Street was already abuzz surrounding the controversial and extremely divisive issue of high-frequency trading, which entered into the investor's lexicon once again due to the well-publicized 60 Minutes interview with Michael Lewis, author of the new book, Flash Boys. In what can only be described as a market hit piece, Mr. Lewis denounced the equity sector as rigged, claiming that high-frequency trading is used by powerful investment firms and banks, including the exchanges themselves, to gain an insurmountable advantage over the commoners.
High-frequency traders, big Wall Street firms, and stock exchanges have spent billions to gain an advantage of a millisecond for themselves and their customers, just to get a peek at stock market prices and orders, a flash before everyone else, along with the opportunity to act on it.
The insiders are able to move faster than you. They're able to see your order and play it against other orders in ways you don't understand.
The problem, however, is that the mere existence of high-frequency trading does not definitely prove market manipulation. At its core, the definition of HFT is the use of algorithms to make trades based on a given set of logical functions. Since these complex algorithms require advanced computer technology, the process by default is incredibly quick, often accomplishing in minutes tasks that would take a human trader several hours to perform. The distinction is important to remember because it's not the tail that wags the dog. In other words, the ability to make fast trades is not immoral, nor is it illegal. Further, it would be extraordinarily difficult to police such a technology, and it would reek of hypocrisy. The advent of the internet has allowed for digital trading to be the norm, and the trajectory of the markets, whether you like it or not, is towards increased digitalization and less human interaction. Of course, some of the critics of HFT will cite commodities manipulation as one of the dubious quote-unquote beneficiaries of the algorithm era, with the precious metals complex taking another hit on Thursday due to technical selling pressure off the backs of a stronger US dollar index. Gold came off slightly from the prior session, down 0.25%, while silver received an inordinate blow, losing 0.8%. However, the platinum group metals have performed relatively well this year and bucked the trend this week, posting modest gains. And that'll do it for this week's edition. Thanks for watching, and we'll see you next week.